Have you ever looked at your savings account and just felt disappointed? I mean, wondered why it's barely earning enough to buy a cup of coffee? You are definitely not alone. For years, savers have been stuck in what you could call a yield famine. But behind the scenes, away from the traditional banks, a whole new system has been booming. It's a sort of shadow banking market called private credit, and it's dangling these double-digit returns that seem, well, almost too good to be true. So today, we're going to pull back the curtain on this massive multi-trillion-dollar industry. We'll get into the incredible opportunity, but also the brutal risks that come along for the ride.
All right, so here's how we're going to break it down. First, we'll tackle the problem head on, the yield famine. Then we'll look at the private credit solution that's popped up. After that, we'll get real about the price of those high yields. Then I'll give you an investor's toolkit so you can look at this stuff yourself. We'll zoom out to see the bigger economic picture, the credit cycle, and finally, we'll hit the most important part, the brutal truth when there are no bailouts. So let's kick things off with Section 1, the yield famine. To really get why private credit is so popular, you first have to understand the deep frustration that's pushing millions of people to search for anything better than a standard savings account.
It's a question that feels like we've been asking forever, right? But it's really the engine driving this entire story. For more than a decade, central banks kept interest rates slammed to the floor, near zero. And in that world, earning a decent, safe return on your cash was basically impossible. And yeah, rates have gone up recently, but the core problem? It hasn't really gone away.
Okay, so these numbers on this slide tell a powerful story about what's happening to your money. Just look at this. The average savings rate is a tiny 0.42%. Meanwhile, inflation is humming along at 3.6%. The math here is simple, and honestly, it's brutal. Let's say you've got $10,000 in the bank. You'll make, what, $42 in interest for the year. But at the same time, inflation just vaporized $360 of your purchasing power. You are literally getting poorer just by leaving your money in the bank. It's like you're on a treadmill that's going backward. This is the yield famine, and it's what sends people searching desperately for a better way.
So, with the big banks offering next to nothing, this huge vacuum was created. And well, a new market absolutely exploded to fill it. This is where we step into the world of private credit, which offers what looks like an incredibly powerful, almost irresistible solution. So here's the quick backstory. After the 2008 financial crisis, a bunch of new rules came in that made it way more expensive and complicated for the big regulated banks to lend money to anyone except the safest, largest companies. This left a huge funding gap for thousands of really good, profitable, medium-sized businesses. And you know what they say, finance abhors a vacuum. So these private, non-bank funds saw their chance and rushed right in. They became the new lenders for Main Street, effectively creating a new shadow banking system.
And this quote just perfectly captures the hook, the big promise. See, for the longest time, this was a game only for huge institutions. But now it's been packaged up so regular investors can get in. And the sales pitch is so compelling. Since the banks aren't making these fat profits on loans anymore, you can. You get to be the bank, and you get to collect those juicy interest payments. We're talking 10, even 12% that used to be just for Wall Street insiders. So how does an ordinary person actually do this? Well, the most common way is through something called a business development company, or a BDC for short. The easiest way to think about a BDC is like a publicly traded fund that's full of loans. You can buy and sell shares of it on the stock market just like you would with a company like Apple, but instead of owning a piece of the tech giant, you own a piece of a company whose entire business model is lending money to hundreds of private, mid-sized companies and just collecting the interest checks.
And this is the most crucial point. You have to have a mental shift here. When you buy a share of a BDC, you are fundamentally changing your role. You're no longer a depositor, where your money is all safe and sound and insured by the government. Nope. You've hopped over the counter. You are now the lender. You're the one shouldering the risk that the borrower might not pay you back. And for taking on that risk, you are demanding, and hopefully getting, a much, much higher interest rate.
Okay, so let's move on because this is where we need to have a very honest conversation. Those amazing 10 to 12% yields, they are not a gift. They're not some secret market hack. They come with a pretty big catch because, as the old saying goes, there is absolutely no such thing as a free lunch in finance. This table right here just lays out the whole concept of risk and reward perfectly. On one side, you have a giant, stable company like Sanofi. Lending them money is seen as super safe, so they only have to pay a tiny 1.23% yield. Then you've got a struggling company like Bed Bath & Beyond. To get anyone to lend them money, they had to offer a much higher 7.68%. So why the huge gap? It's because the market knew there was a much higher chance Bed Bath & Beyond could go bankrupt. That extra yield wasn't a bonus, it was hazard pay. And that quote right there is the key takeaway you have to burn into your mind. That tempting 10% yield from a BDC isn't magic money. It is your direct payment for willingly accepting the very real risk that some of the companies the BDC lends to could hit hard times, stop paying their bills, and in the worst case, go totally bankrupt, wiping out your loan. You are literally being paid to worry. All right, so now that we've established that yield is really just another word for risk, let's get practical. How can you, as an investor, tell the difference between a well-run, conservative BDC and a really reckless one? This next part is all about giving you the tools to pop the HUD and analyze a BDC's loan portfolio for yourself. So the very first thing you need to check is the non-accrual rate. I know it's a fancy accounting term, but all it means is what percentage of the loans have gone bad. So imagine the BDC made 100 loans. If 5 of those companies stopped paying their interest, the non-accrual rate is 5%. Simple as that. This number is a direct hit to the BDC's income, and that means it's a direct hit to your potential payout. A low and steady non-accrual rate is a great sign. A rising one? That's a huge red flag. Next up, you've got to understand your place in the food chain. The absolute gold standard for safety here is something called first lien senior secured debt. First lien means you are at the very front of the line to get paid back if the company goes belly up. Senior secured means your loan is backed by actual stuff, collateral like the company's buildings or equipment. Think of it like a mortgage. If you stop paying, the bank takes the house. This is the safest position you can be in as a lender. And this chart shows you exactly why being first lien matters so much. When a company goes bankrupt, there's a strict legal pecking order for who gets paid. The first lien, senior secured lenders, are at the top. They get paid first from whatever is left. If, and that's a big if, there's anything left over after they're paid in full, then the next group gets a shot. By the time you trickle all the way down to the common stockholders at the bottom, there is almost always nothing left. Their investment goes to zero. Where you are in this waterfall is everything. So when you're looking at a BDC, you want to see a portfolio that looks a lot like this chart here. A high-quality, more conservative BDC will have the lion's share of its portfolio, 85% or more, in those safer first lien loans. If you see a BDC that's heavy on riskier stuff like second lien debt or equity, you just have to know they're reaching for higher returns, but they are also taking on way more risk of losing your money for good if things go wrong. And one last tool for your kit. Look for floating rate loans. The good news is most BDC loans are structured this way. It just means the interest rate they charge isn't fixed. It moves up and down with a benchmark rate, like the one the Fed sets. Now, in a period of high inflation where rates are going up, this is a huge advantage for the BDC. As the benchmark rate rises, the interest payments the BDC gets automatically increase. That boosts its income, and it helps protect your payout from getting eaten alive by inflation. It's a really powerful built-in feature. Now, knowing all those portfolio details is absolutely critical because every single loan portfolio, I don't care how well it's built, eventually gets put to the test by the unforgiving rhythm of the economy, what we call the corporate credit cycle. This is the big picture that controls everything. You have to understand, for the kind of mid-sized companies that BDCs lend to, credit is like oxygen. It is not a luxury, it is essential for survival. Sure, they use it to grow, but more importantly, many companies just keep rolling over their old debt. They take out new loans to pay off the old ones. And that system works just fine when money is cheap and easy to get. But when the cycle turns and credit markets freeze up, that lifeline gets cut. And this is the dangerous downward spiral that can happen during a recession. It starts when credit just dries up. All of a sudden, companies can't refinance their debt, so to get cash, they're forced to sell off assets, usually at bargain bin prices. This flood of selling pushes asset prices down for everybody, which makes everyone's balance sheets look worse. That leads to more defaults, which makes lenders even more terrified to lend, which dries up credit even more. It's a vicious cycle that can absolutely cripple the very companies BDCs are built on. And that whole deleveraging cycle brings us to our last and, honestly, our most critical section. If you only remember one thing from our time together today, please make it this. This is the brutal, unavoidable truth about private credit. And this slide just lays it out in black and white. It's a night and day difference. The money in your bank account, that's a deposit. It's protected up to $250,000 by the U.S. government through FDIC insurance. The banks themselves have a safety net. They can borrow from the Federal Reserve. Now look at a BDC investment. It has none of that. Let me be perfectly clear because this is so important. It is not a deposit. There is no government insurance. There is no government bailout. You chose to be the bank, but you don't get the bank's protections. If the loans inside that BDC go bad, your money is completely at risk.
So we have to end with this one crucial question. As corporate defaults start to climb and the economy gets a little shaky, this isn't some theoretical risk anymore. Look, private credit can be an amazing tool for generating income, especially when you can't find it anywhere else. But it comes with real, bank-level risks without any of the bank-level safety nets. And so every single investor has to look at their own situation, their own comfort with risk, and decide for themselves if that trade-off, that alluring promise of a high yield versus the very real potential for a total loss, is a bet they're really willing to make.